Hello traders, this is a video about how when markets are ranging like S&P and Nasdaq are ranging for months, when you determine inflection points correctly, you can use them same zones over and over again. So this is a tweet about narrow overnight ranges on S&P and Nasdaq futures with the rudimentary zones, which I published on Tuesday, February the 10th, and this time is Central European time. This means 19 minutes before market actually opened on Tuesday. So this is that chart, 19 minutes before Tuesday, and now this is the same zones now after the week is over. So what happened? This was that Tuesday. First, they made a spring below the pre-market low. Then they hit that resistance zone with just a poke above, went down. That was for Tuesday, usage of a zone. Then on Wednesday, they opened at the same zone, made a poke above, went down. On the way down, they tagged the untested opening level from Monday. Then the next day, so this was Wednesday, then on Thursday, they again tested the same zone and opening level of Wednesday, went down through this zone, which then was used as resistance. And finally on Friday, this would be the overnight range on Friday, and this would be the CPI, the origin of the CPI move, while this would be test of a zone, which was labeled as RTH because this is the RTH value here of the previous Thursday. And what they did here was a spring below overnight low, which Nasdaq futures made this week 3 times. After which they went higher, tagging this zone again, then making a false breakover and rolling down. So basically, just of these here predetermined references zones, and this here, which was labeled at that point in time, it was Tuesday, it was labeled as yesterday open, meaning Monday open. You had then later several reactions like 1, 2, 3, 4, 5, 6, 7. And that's possible when market is in the range. And when market is in the range, you are looking exactly for this, for fades and false breaks. Thanks for watching.